So this might sound a bit backwards, but the cheapest mortgage rate you see online is very often the wrong one to choose. And I say that because people fixate on the rate first, not because they're careless, but because they're trying to actually be sensible. Especially professionals. You're busy, you're analytical, you want the best number, the cleanest decision, and something that you can just tick off that long to-do list that you've got. And by the way, just before we even get into the bigger point, sometimes the cheapest rate isn't even the cheapest mortgage, because you'll often see a rate that looks amazing and it's got maybe a fee of £1,499, maybe even £2,000 in some cases. And if you're borrowing a smaller amount or you're only fixing for 2 years, that fee can wipe out the benefit of the lower rate completely. So people think they're getting a bargain, but when you actually do the maths properly, the overall cost is much higher. Now that's important, but honestly, that's not even the main worry. The bigger issue is that people chase the cheapest rate and they end up with the wrong deal altogether. Now, if you're new here, by the way, I'm Craig. I've been helping people with mortgages for over 25 years. So if this kind of content is useful, please do consider giving the video a thumbs up and subscribing to the channel. It helps us and it helps others to also find us. So let's talk about why that headline rate can quietly cause problems later. What I see is a lot of people coming to me saying, I found a cheaper rate than the one you mentioned online. Why wouldn't I just take that? And on the surface, that's a completely fair question. Lower rate, lower payment, job done, right? Well, the thing is, that logic assumes that mortgages are static, and they're not. Because lenders don't price mortgages purely on generosity, they price them on risk. And when you see the very cheapest rate available, it's usually sitting on top of some pretty tight assumptions. Assumptions about your income staying exactly as it is. Assumptions about you not needing flexibility. Assumptions about you not changing anything for years. And that's fine until life does what it usually does. And this is where people get caught out. Let's take a really common professional scenario. You're earning well, but your income isn't just a simple salary. There might be bonuses, dividends, commission, retained profits, or plans to change roles, step back slightly, or maybe change your employment style altogether and perhaps go self-employed. The cheapest rate on the market might look brilliant today, but it could be with a lender that's incredibly unforgiving later. No overpayment flexibility, heavy early repayment charges, strict criteria if you want to borrow more, or very little appetite to help if your situation changes even slightly. And most professionals don't realize this at the point they're choosing the deal, because all of this sits in the small print, not in the headlines. You see, the problem with focusing only on the rate is that it reduces the decision to a single number, when actually it's a structure decision. Because the real cost of a mortgage isn't just the interest rate you pay. It's the risk that you're accepting alongside it. The risk of being boxed in. The risk of being forced onto a bad deal later. The risk of having no good options when timing really matters. And that's the important bit. Now, I've seen people save a tiny amount on paper, maybe 0.1, 0.2%, and then lose far more later because they couldn't move, remortgage, or adapt when they needed to. And what's frustrating is that none of this is obvious when you're comparing deals online. Comparison tables don't show future friction. They don't show how a lender behaves when things aren't perfect. What tends to happen is people optimize for the rate they can see today instead of the flexibility that they'll need tomorrow. And very often a slightly higher rate, structured properly, ends up being cheaper overall. Less stress, more control, and better outcomes. Once you've been through enough market cycles like I have, you realize this. The best mortgage isn't the one that looks clever at the start. It's the one that still works for you when life nudges you off the original plan. If this way of thinking makes sense, there's another video on screen now that goes a little bit deeper into how lenders assess risk and why timing and structure matter more than people might expect. It will link nicely with this video. And if this added value, please feel free to give it a like or follow the channel. It really does help the channel reach people who need it. As always, mortgage decisions should be based on advice tailored to your own circumstances. This is about understanding how to think about the choice, and it's not replacing personal advice.